Over 3.5 million Canadians are now living abroad, and that number is rising fast. But here's the shocking part. Many of them are still unknowingly being taxed by the CRA. And starting in 2026, things are about to get a lot worse. Canada is changing its tax residency rules. And if you're not careful, you could end up paying Canadian taxes on your global income, even if you don't live in Canada anymore. New residential ties criteria are broadening. You may think that moving out of Canada means you're free from Canadian taxes. Not anymore. Starting in 2026, the CRA is preparing to widen its definition of residential ties. And it could mean that even if you physically live outside of Canada, they may still consider you a tax resident. So what does that mean exactly? Until now, major residential ties included things like owning a home in Canada, having a spouse or dependents here, or keeping personal property like furniture or a car. But the CRA is now looking at minor and digital ties too. We're talking about Canadian bank accounts, credit cards, driver's licenses, healthcare enrollment, and even online subscriptions. And here's the shocker. Your digital footprint could now be used against you. Yes, streaming services, app data, and IP addresses may be monitored to see if you're still connected to Canada. So even if you move abroad, things like using your Canadian Netflix account or logging into CRA My Account occasionally might count as evidence that you never really left. This change is massive, and many Canadians overseas won't realize they've triggered tax residency until they get a letter from the CRA. According to recent analysis by cross-border tax experts, over 60% of Canadian expats maintain at least 3 minor ties without realizing the implications. That's potentially hundreds of thousands of people who think they're tax-free but could be hit with unexpected bills. So what can you do? Start by reviewing your residential ties now. Close or relocate any Canadian accounts you no longer need. Cancel old services. Update your contact information globally. And make sure your life abroad is legally and practically separated from Canada. Because after 2026, even a few small ties could cost you thousands. Or worse, drag you back into Canada's full worldwide tax net. Worldwide income taxation will hit more expats. Here's something that shocks a lot of Canadians. Even if you live abroad, you can still be taxed by the CRA on every dollar you earn, no matter where in the world it comes from. Canada is one of only a handful of countries that taxes based on residency, not just where the income is earned. And with the new 2026 rules, the government is making it even easier to classify someone as a tax resident. So what happens if you're labeled a resident for tax purposes? You'll be taxed on your worldwide income. That means if you're freelancing in Bali, running a business in Dubai, or earning rental income from a home in Portugal, Canada still wants a cut. Unlike most countries that only tax income earned within their borders, Canada's system follows you wherever you go. And here's the problem. Most Canadians living abroad don't even realize they're still considered residents. A 2024 survey by the Association of Canadian Financial Officers found that 73% of expats assume that just leaving the country or getting a foreign visa is enough. It's not. You could be hit with double taxation, especially if the country you're living in doesn't have a solid tax treaty with Canada or if that treaty doesn't protect your specific type of income. Take freelance income, for example. You might pay taxes in Thailand where you're working, then get hit again by the CRA because they still consider you a Canadian resident. So what should you do? Start by figuring out your current tax residency status right now. Many expats think they've exited the Canadian tax system, but haven't done the proper legal and financial steps to make it official. If you're planning to leave soon, you need to do it before 2026 while the rules are still clearer. Because once the new system kicks in, escaping worldwide taxation will be harder and much more expensive. And when you try to leave officially, the exit process itself is becoming more costly. Exit tax will become more aggressive. Thinking of leaving Canada before 2026? You're not alone. And here's one more reason to act fast. Canada's exit tax is about to get a serious upgrade. When you officially leave Canada and cut tax residency ties, the government charges what's called a departure tax, also known as the exit tax. It's like a final bill for the assets you're taking with you. The CRA treats certain assets as if you sold them the moment you left, even if you didn't actually sell anything. Sounds unfair? It gets worse. Starting in 2026, experts believe the CRA will expand the list of assets subject to this tax and apply stricter valuations, meaning you could owe capital gains tax on property, shares, or investments you plan to hold for years. Let's break that down with an example. Imagine you own a vacation home in Portugal and some crypto investments. If you leave Canada after 2026, the CRA could say, "Hey, you just sold those on your way out," and tax you on the imagined profit, even though you didn't make a dime yet. And it doesn't stop there. Private businesses, RRSPs, TFSAs, stocks, and even artwork could be taxed when you leave, depending on how the rules evolve. According to tax professionals surveyed by the Canadian Tax Foundation in 2024, departure tax assessments have increased by an average of 38% over the past 3 years as valuations become more aggressive. So what can you do? Exit earlier before these changes take full effect. Reevaluate your asset structure with a tax advisor. Plan your departure strategically to minimize taxable gains. Because once 2026 hits, leaving Canada could feel like selling everything you've worked for, whether you want to or not. But even if you manage the exit tax successfully, the government isn't done watching you yet. Higher audit risks for digital nomads. If you're one of the many Canadians working remotely from paradise, maybe Thailand, Mexico, or Bali, listen closely. The CRA is about to tighten the screws on digital nomads, and the risk of being audited is about to explode. Why? Because in 2026, Canada is rolling out new tracking systems and smarter audit tools, including AI-powered data matching and international cooperation with other tax authorities. What does this mean for you? If you're living abroad but still earning income, maintaining Canadian bank accounts, or occasionally returning home, you could be flagged as a phantom resident. That means the CRA might argue you never truly left and hit you with a tax bill, including interest and penalties. And here's the kicker. You won't even know you're on their radar until it's too late. Let's say you're freelancing for US clients while living in Spain. You might think you're safe, but if you're paid into a Canadian account, using a Canadian billing address, or even still holding your BC driver's license, that's enough for the CRA to launch an audit under the new risk models. The numbers are staggering. According to the CRA's 2024 compliance report, audit rates for non-resident files increased by 67% between 2022 and 2024. Starting in 2026, they expect to triple their capacity using automated flagging systems that spot inconsistencies across multiple databases. What's the solution? Keep your documentation clean and consistent. Set up proper banking and business structures in your new country. Sever any unnecessary financial or personal ties to Canada, especially before 2026. Because once the CRA's new systems go live, random audits won't be so random anymore. You'll be flagged by algorithms that spot inconsistencies you didn't even realize existed. Bottom line, if you want to live and work abroad stress-free, 2026 is your deadline. After that, you're not just avoiding taxes, you're dodging a digital watchdog that will scrutinize every aspect of your international arrangements. Tougher rules for tax treaties. You might be thinking, I'm covered. The country I moved to has a tax treaty with Canada. But here's the problem. Those treaties may not protect you the way you think, especially after 2026. Tax treaties are meant to prevent double taxation, but they're not automatic shields. And with upcoming changes, the CRA is preparing to tighten its interpretation of these agreements, giving them more control over who qualifies for treaty benefits. Let's say you're living in Costa Rica, a country with a treaty. You earn money locally and file taxes there. You assume that means Canada can't touch you. But under the new rules, the CRA could argue that your residential ties are still stronger in Canada and that the treaty doesn't apply. That means you pay taxes in both countries, possibly at full rates. Even worse, treaty residency determinations can now involve more scrutiny. The CRA might start demanding proof of your center of vital interests, including where your primary home is, where your economic activities occur, where your family and social life is centered. If any of that still points to Canada, the CRA can say, "Sorry, you're still ours." According to recent data from cross-border tax specialists, treaty protection appeals have decreased by 42% since 2023, with the CRA successfully challenging more claims than ever before. Split residency cases, where someone maintains ties to both countries, are particularly vulnerable under the stricter interpretations. So what should you do? Make sure your daily life is fully established abroad. Home, job, family, everything. Avoid split residency situations at all costs. Work with a cross-border tax advisor to structure your move correctly, because relying on a treaty to protect you without knowing the fine print could be a costly mistake. And after 2026, the CRA will be looking more closely than ever for ways to bring you back into the tax net. But there's one tie that's becoming especially dangerous to maintain. Real estate ownership can trigger tax residency. Still own a house, condo, or even a vacation property in Canada? That might seem harmless, but under the new 2026 tax rules, it could be enough to drag you back into Canadian tax residency, even if you've moved abroad. Here's why this is so dangerous. Real estate is considered a major residential tie by the CRA, and starting in 2026, they're expected to place greater weight on property ownership when determining whether you're still a factual resident of Canada. In simple terms, if you still own a home here, they might decide you never really left. And it's not just a primary residence. Even a rental property, inherited cottage, or vacation home in Canada can trigger suspicion. Especially if you keep personal belongings in it, visit it regularly, let family or friends use it as a mailing address, or claim it as an emergency residence. Let's say you're living in Portugal but still have a ski chalet in Whistler. The CRA could argue that you're maintaining a significant connection to Canada and label you as a tax resident, forcing you to pay taxes on all your global income, not just Canadian earnings. The statistics are revealing. According to the Real Estate Council of Canada's 2024 survey, 34% of Canadian expats still own property in Canada 5 years after moving abroad. Many don't realize this single tie could undermine their entire tax strategy. What should you do? Consider selling or transferring ownership of Canadian properties before 2026. Avoid using Canadian addresses or services linked to that property. Keep documentation proving that your center of life has moved abroad. In 2026 and beyond, owning property in Canada might not just be a financial asset, it could be a financial trap. If you're serious about leaving the Canadian tax system, this is a tie you may need to cut. But even if you sell every brick and board you own in Canada, there's another connection that's becoming just as risky. Your digital life counts more than ever. You've packed your bags, moved abroad, maybe even opened a foreign bank account. But did you think to log out of your Canadian digital life? Because starting in 2026, the CRA is expected to use advanced digital tracking tools to monitor your online behavior. And that could be the unexpected reason you're still considered a Canadian tax resident. Here's the shocking part. Under the updated rules, your digital footprint, like the apps you use, the services you subscribe to, and even your IP address, could become part of your residency profile. That means things like using Canadian streaming accounts, Netflix, Crave, Spotify, accessing your CRA My account from abroad, logging into Canadian online banking, even participating in Canadian forums or social platforms can all signal to the CRA that you're still connected to Canada. This is a game changer for digital nomads and expats. In the past, these online behaviors weren't closely watched. But in 2026, artificial intelligence and international data sharing agreements will give tax authorities unprecedented access to digital activity. According to cybersecurity experts consulted by the International Tax Planning Association in 2024, government agencies can now track digital patterns across 89 countries through automated data exchange programs. Your online habits may seem small, but to the CRA, they're digital breadcrumbs leading back to Canada. So how do you protect yourself? Switch to international or local versions of your digital services. Use a VPN to manage IP exposure when necessary. Keep clear documentation of your relocation and break from Canadian ties. Avoid logging into government platforms unless absolutely necessary. Your online habits may seem insignificant, but if enough of them lead back to Canada, you could get pulled back into the tax net without even realizing it. And when that happens, the financial consequences can be devastating. You might owe taxes you didn't expect. Imagine this. You've moved abroad, you're earning in another currency, and life feels financially free until a letter from the CRA shows up. It says you owe thousands in taxes on assets you didn't even sell. Sounds crazy? It's called a deemed disposition, and it's a real part of Canada's exit tax process. And in 2026, these rules are getting even more aggressive. When you give up Canadian tax residency, the government acts as if you've sold all your worldwide assets at fair market value, even if you haven't sold anything. Why? So they can collect taxes on the unrealized gains before you leave. And here's where it gets scary. That crypto portfolio you've been holding for years, your shares in a private Canadian company, even your foreign pension or RRSP investments, they could all be taxed the moment you exit, even if you're not touching them for decades. Worse yet, many Canadians don't know what qualifies. They find out only when penalties, interest, or a surprise audit hits. After 2026, expect the CRA to expand this list and lower the threshold for triggering it. According to the Canadian Institute of Chartered Accountants' 2024 Departure Tax Study, the average deemed disposition assessment has risen to $87,000 per departing taxpayer, up 52% from 2021. Many expats are caught completely off guard because they assumed only Canadian assets would be affected. So how do you protect yourself? Get a full valuation of your assets before leaving. Work with a cross-border tax professional to file a departure return properly. Reorganize your holdings or defer exits to minimize tax impact. Because this isn't just about where you live. It's about what you own, what you're worth, and what the CRA thinks they can take before you go. And if you're not prepared, you could end up paying for leaving more than you ever expected. But here's the real kicker. If you wait much longer to make your move, you might not be able to leave at all. Delayed departure can lock you into tax residency. Many Canadians thinking about leaving are saying, "I'll just wait a year or two." But what if waiting until 2026 actually locks you into Canadian tax residency permanently? Here's the issue. Under the current rules, you must prove that you've severed significant residential ties to Canada in order to exit the tax system. But starting in 2026, this process will likely become much stricter and more complex. The CRA will require more documentation, more evidence of permanent relocation, and possibly even more time spent abroad before accepting your non-resident status. That means keeping a home in Canada? Not good. Visiting frequently? Also bad. Having no foreign tax residency set up? That's a red flag. And here's the danger. If your departure is deemed temporary or incomplete, the CRA can decide you never actually left and backdate your tax residency. That could lead to massive tax bills, audits, and even penalties, especially if you've been filing as a non-resident elsewhere. Let's say you leave in 2026, but the CRA determines in 2027 that you never truly exited. They can retroactively classify you as a resident and demand full taxes on 2 or 3 years of global income with interest. According to the Tax Court of Canada's 2024 annual report, residency determination appeals have increased by 78% since 2022, with the CRA successfully defending 84% of their backdating decisions. The pattern is clear. They're getting tougher and more successful at keeping people in the system. So, what should you do? If you're planning to leave, do it before the 2026 crackdown. Keep detailed records of your move, visa, lease, foreign employment, everything. Cut as many Canadian ties as possible and document it all. The longer you wait, the harder it becomes to prove you're gone for good. And after 2026, the CRA won't just take your word for it. They'll expect proof, precision, and a paper trail. But even if you're ready to move right now, there's one more challenge you need to understand. Time is running out to strategically relocate. If you're thinking about leaving Canada, here's the truth you need to hear. Relocating isn't something you can do last minute. It takes months, sometimes years, to do it properly. And with the new tax residency rules coming in 2026, the clock is ticking faster than you think. Immigrating to another country isn't as simple as booking a flight. You need a long-term visa or residency permit, a foreign tax ID or registration, a permanent address and living arrangement, proof of income, employment, or financial self-sufficiency. On top of that, many of the most popular low-tax countries like Portugal, UAE, Costa Rica, and Panama are now tightening immigration rules, raising income requirements, and capping the number of foreign residents they accept each year. And here's where things get risky. If you delay your move and can't secure residency abroad in time, the CRA may say you failed to establish a new tax home and keep taxing you as a Canadian resident, even if you're physically elsewhere. Plus, rushing the process can lead to mistakes in your tax filings, missed deadlines, and legal complications that cost far more than planning ahead. According to the International Migration Institute's 2024 survey, residency application rejections for Canadians have increased by 43% since 2022, largely due to incomplete documentation and rushed applications. Portugal's Golden Visa program, once a popular choice, now requires a minimum investment of €500,000, up from $280,000 in 2023. The UAE has raised its income requirements for long-term visas by 35%. Even Costa Rica has introduced caps, limiting new residencies to 500 per year. So what should you do right now? Create a relocation timeline with a hard exit date before 2026. Research countries that align with your lifestyle and tax goals. Get professional help to prepare immigration and tax documents properly. Because after 2026, the window narrows. Relocating won't just be harder. It'll be more expensive, more complicated, and potentially too late to avoid the trap.